Hello and welcome to the Genuine Learning blog. My name is Melissa Galasso, and today we're going to talk about a FASB ITC, Identifiable Assets and Subsequent Accounting for Goodwill. Now, ITCs are unique in that they are not like exposure drafts. They are they do not express any preliminary views of the board. Instead, they are alternatives, and they're just collecting feedback, and then it may or may not result in actual amendments to the standard. And so when we think about these are not the same level of detail as an exposure draft. They're more in a high level beginner phase. So this was issued on July 9th and comments are due October 7th. So we have a good amount of time. They're really interested in this, and it is file reference number 2019-720. So what is the background here? Well, FASB doesn't know what we want. They get a lot of mixed opinions, and therefore they can't really decide what's the appropriate treatment. So goodwill amortization, some people want it back for everybody. Users seem to not believe that. And so as we go through that, it's been very difficult for FASB. So when we look at this, we're really focused on public business entities. Now that ASU 2014-02 allows private entities to amortize their goodwill, 2019-06 allows nonprofits, the only people who can't amortize their goodwill are public business entities. And we're trying to determine whether the benefits justify the cost related to doing the full goodwill impairment test. They have not received enough feedback that's consistent or conclusive, and so they're putting it out there to try it again. So some of the issues that they're coming across, the benefits of the accounting for intangibles and goodwill do not justify the cost to prepare and audit it, right? That's a common issue that they hear, that it's a very expensive process. You have to hire a valuation expert, and it can be very daunting. Goodwill impairment charges often lagging indicator of the economic factors, and therefore they're non-recurring and adjusted in the investor's analysis or eliminated through non-GAAP metrics. So because they are one-offs, they're not typically going to be included in the calculations. And then there's concern that measures of certain identifiable assets are not verifiable, comparable, or distinguishable from goodwill. So today we have to identify all identifiable assets and separate them from goodwill. And so as a result, because they're not very comparable and they're very difficult to verify, not necessarily providing useful information, knowing that they exist is typically sufficient. And then obviously having to go through that process, people have indicated that's very expensive. Now, why do we like the process of doing goodwill impairment? Well, a charge to impairment tells someone that maybe people are underperforming against expectations, right? That goodwill, we said, was valuable when we bought it. We paid extra for it, but we're not performing to that expectation. It also holds management accountable for poor capital allocation decisions, and that's not really the purpose of the test, but it does give us that impact. And then benefit from understanding the existence and value of identifiable intangibles recognized despite concerns about reliability. So again, they hear both sides of the story. Yes, we like it. No, we don't. And so as a result, as I mentioned, private companies are already amortizing their goodwill, as are nonprofits under the most recent standard that was just issued. So what's going on in this ITC? Well, there are 4 sections of the ITC. We're only going to address 2 of them in this blog. We're going to address Section 1 and Section 2. Section 1 covers whether to change the accounting for subsequent goodwill. Should we impairment test or should we amortize? Section 2 talks about whether to modify the recognition of intangible assets in a business combination. Do we need to identify those identifiable intangibles, or can we lump them into goodwill? Section 3 is about disclosures about goodwill and intangibles, and then Section 4 is about comparability and scope. So let's take a look at Section 1. That's probably the one that's getting the most attention, and going back to that cost and complexity. Impairment testing is very subjective. It increases audit risk and audit cost. It's also just expensive from having to hire a valuation person. As a result, it's tested at the reporting unit level, so you have to identify costs at that level and assign goodwill to those reporting units, and that can be very expensive if they have multiple successive acquisitions, and they do not have the internal specialist, so typically they have to hire an external valuation specialist, which can be very expensive. So cost and complexity are really the complaints that we get for impairment testing. So option 1 is to amortize the goodwill, right? So we would just, as we go through this, have a write-off systematically of goodwill. It would make impairments less likely because you're amortizing it. However, you could still have them. So the downside to this, there is a conceptual basis for existing goodwill impairment model simply because we don't see a systematic decline, right? Goodwill doesn't kind of carry off as a, systematically at the same values each period. On the other side, we think about this as the amount allocated to the periods that we're recognizing the benefit of the acquisition. So the acquisition, and then we have the benefit, so we're recognizing over that acquisition. So there are models that can get used to amortization, and there are also ones that say no amortization. So the big question is, if we are going to go down the amortization route, what is an appropriate period of time, right? So for nonprofits and for private companies, they've gone with 10 years. Right, so that's and it's a period up to 10 years. So that's one option. When I was in college, I learned to amortize goodwill over 40 years. So what's the right number? So they're looking at, is it a default period? Is it a cap or maximum, like up to 10 years? Is it a floor or a minimum? Can we justify an alternative measurement method other than a default period? Acquisition based on the useful life of the primary identifiable assets. That's very possible for public companies. Amortization based on the weighted average useful life, or management's reasonable estimate. So they're throwing it out there to us, asking what do we think is a reasonable period of time. Option 2 is to continue to try to simplify impairment testing. So first they offered what we call step 0, or the qualitative assessment, as their first aim at making this simpler. Then in 2017 they issued 2017-04 and removed the step 2 of the impairment test, which is when we had to do the implied goodwill calculation. They removed that. So what other things can they do to continue to simplify? Potentially not doing it annually, only doing an impairment test when it's triggered, or doing it at the entity level instead of the reporting unit level to reduce cost. So then once we've gotten past the amortize or not, the next one is, what do we do with these identifiable intangibles? And they've come up with a couple of different approaches. In approach 1, we would extend the private company alternative and just subsume certain CRIs, which are called your customer-related intangible assets, and all non-compete agreements. Or in approach 2, we would do a principles-based criterion for your identifiable assets. In approach 3, we subsume everything into goodwill. Or step 4, we keep the existing guidance as is. So as you can see, this is something that FASB is in the initial discussion phases on. They want more feedback to see if there's any consistency, because they're hearing 2 different things from different people and they don't know what's the appropriate response. So again, we want to keep that in the back of our mind as we're going through this, that FASB is really looking to see if there's any consensus out there. So 4 sections, we've covered 2 of them today. If you are so moved by this, we encourage you to comment before the comment period ends and give FASB the information that they need to make a decision for public business entities. All right, that's it for today's Genuine Learning Vlog. I hope to see you on a future vlog. Have a great day, guys. Bye-bye.